Hello, I'm Brian Resnick. I'm a senior investment strategist with AllianceBernstein, and welcome to Uncommon Capital, a podcast where we explore the far corners of the private markets and learn important lessons from professional investors. Today, I'm excited to be sitting down with Roger Newkirk. He is a managing director at AB CarVal and a portfolio manager for the AB CarVal Credit Opportunities Fund. Prior to joining AB, Roger was an executive director at UBS, and prior to that, a director at Barclays Capital. He has over 25 years of investment experience, earned an MBA from Columbia University, and is a CFA charter holder. Roger, thanks for coming in and sitting down with us today.
Thank you for having me on the show.
Great. So, it's interesting. I was looking at your career, and one of the things that hopped out at me is just how many entrepreneurial things that you have been a part of. So if you think about it, from the launch of the LATAM trading desk to the launch of AB's CarVal's interval fund business, have you thought of yourself as an entrepreneur? Is this a coincidence, or do you kind of think of yourself as an entrepreneur?
That's a good question. I actually do think of myself as an entrepreneur. I started a business at a young age, actually as a teenager. So before I came into the world of finance, it was a skateboard park and pro shop.
So I have to double click a little bit on the skate park. Were you a skater growing up? Is that your background?
I was a skateboarder as a young child. I don't know, maybe 11, 12 years old. I got involved in skateboarding. And I've always been, I'll call it entrepreneurial. And I went from mowing lawns and raking leaves and doing things that kids do when they have small businesses to really pivoting that into opening up a skateboard shop and ultimately
How does a teenager go about opening up a skate shop?
So I actually started out of my parents' basement selling skateboard products to kids at school. I would show it up at the different parks, anywhere people go to skate, and try to sell them products. Eventually, I'd saved up enough money. I bought myself my first car, which was like a 1982 Celica GT.
Did you have to take a loan out? How did you work that out?
Everything was bootstrapping. I started with all the capital that I raised from my other small businesses as a kid. And ultimately, I went from the basement to the office. I left home at the age of 16 on my own, so this had to work. And ultimately, I figured out, well, it's kind of hard to get kids to show up at an office. And I go out and find them and hand out flyers at different places where people skateboard. Maybe I should have an indoor skateboard park. And I found this space. It was a couple thousand square feet. It had a warehouse. It had a storefront, which was perfect to set up this business. And I effectively had a pro shop and an indoor skateboard park that I had designed and built by myself.
How did you end up going from owning a skate park to coming into the financial services industry?
My skate park was burglarized twice. Well, the pro shop was, right? And I had an injury, and when I called my insurance agent, the phone was disconnected. And I had been a victim of insurance fraud.
Wow. So you learned early on to be very careful about any sort of underwriting, whether it's insurance or private credit or anything. That's a great early experience. I mean, terrible, but clearly
terrible
learned.
experience, but ultimately that's what brought me to the world of finance when I decided to go to college, 2 years after I had actually graduated from high school.
You didn't take out any private credit to start your skate park?
Unfortunately, no.
But your focus career-wise nowadays is largely on private credit. A lot of money has come into private credit. Is it crowded? Is that something that concerns you in the private credit space in the areas that you're focused on?
Yeah, that's a good question. A lot of people out there are talking about private credit, but most of them are actually talking about direct lending. What we do is really asset-based private finance. We're looking at assets that are more granular, assets that aren't necessarily corporate related. We try to focus on investments that are relatively short duration. You can think 3 or 4 years. And in addition to that, what we're really focused on is granularity. And granularity, from my perspective, is really important because it provides diversification.
So when you say granularity, just to double click on that, you're talking about smaller balance loans to consumers and small businesses and these sort of things, as opposed to what's typically thought of as private credit, which are large direct loans, often to private equity sponsored companies. So in terms of the supply and demand dynamics for that type of capital, is that a different picture than direct lending?
Yeah, I would say on the asset-backed side, it's less competitive versus direct lending, but is obviously becoming more competitive over time as other asset managers are looking to get into this space. It's something we've done for over 3.5 decades.
I mean, tell me about what it takes to be successful in that space relative to a traditional corporate underwriter. How does it differ, and what does it take to have success there?
Yeah, I think really at the end of the day, it's being able to source the assets. And sourcing the assets comes from having boots on the ground, whether it's your own team, whether it's partnerships that you have. And if you can source those assets and do it with a partner that allows you to negotiate bilaterally, meaning I'm not in competition with 7 other people, we can get a lot more structural protections. And I think that's what makes the business a bit different from, call it the direct lending side versus what we're looking to do on the asset-based side.
Would you say that the supply-demand dynamics are a little bit different in terms of the amount of folks supplying asset-based finance or private asset-backed investments versus the demand for them?
Yeah, if we think about the bank retrenchment, this is really a growing space. Call it 6 trillion on its way to 10 trillion by 2028 by some people's estimates. And therefore, I think it's actually a lot bigger than the direct lending market, which really leaves room to find your niche or your special sauce, I would say. Where am I going to focus? What opportunities do I want to look for? What is great about what we do is we're focused not only in the United States, but we're also looking at opportunities in Western Europe. Right. And therefore, we can compare and contrast different opportunities. Sometimes there's dislocations driven by regulation or things that are happening in one country, but not another. And I think the more, I'll call it feelers we have out there in these different markets, the better I think we are in a position to find differentiated opportunities.
How do you think about managing these less liquid assets in an interval fund when historically they've been managed in things like drawdown funds that have multi-year lockups and where the manager can call capital when they want?
Yeah, it is a little bit challenging from the private credit perspective because those transactions have a very long gestation period. We could think we're closing August 1st. It rolls out 2 weeks, 3 weeks, sometimes a month. And I have to decide, or we have to decide what we're going to do with that.
And when you say closing, you mean closing a private deal?
Yeah, actually closing the deal and funding the transaction.
So you're managing a portion in more liquid strategies alongside the primary strategy of investing in private markets. So if I'm hearing this correctly, you're really saying that understanding the roadmap of when the private deals need to close helps you manage the liquidity on the other side.
Correct. At the end of the day, I know I have cash coming in the door. I have cash going out the door. We need to make our quarterly share repurchases. We need to make our quarterly distributions. I'm very focused, hyper-focused, in fact, every day looking at the liquidity in the fund, following up with the investment teams to really understand, is this deal going to close on Friday or is it a week from now?
So you would say that in a way, managing an interval fund has another dimension to it relative to just managing a traditional private fund.
Yeah, I would say a traditional private fund most likely is in a drawdown vehicle where you have an investment period, you have a harvest period. That money could be locked up for 6 or 8 years. You don't have to make those day-to-day decisions. With the interval fund, we're in a position where we really have to make those day-to-day decisions, and therefore we're trying to build out the tools to allow us to handle that as efficiently as possible. The big benefit of the interval fund type structures, as soon as you put the money into the fund, ultimately your money is put to work day one, which allows that money to earn a return and to compound that return, as opposed to a drawdown vehicle where your money is going to get called. You have to sit there and figure out what you're going to do with it before it's called. And you don't always know when it's going to get called, right? And those are the challenges effectively that I'm handling for the investor at the end of the day, right?
And do you see institutions gaining interest in interval funds?
I mean, I think they could, right? We're actually taking away the challenge of doing something with that capital before it's called. In most of our drawdown vehicles in general, it's really hard to tell people exactly when you're going to draw that capital, particularly if you're being opportunistic, right? You may be waiting for a dislocation. I talked about the gestation period of a deal, and that could take 6 months. It could take 7 months. You don't really know. And therefore, I think an institution could utilize an interval fund to really take that problem away from themselves and put it on somebody else.
Excellent. Thank you for that. If I think about your career, again, you've managed illiquid and liquid assets across the globe. I imagine you must have seen or experienced a period in which illiquidity or liquidity was mismanaged. Can you think of a time where you saw that and where it was really problematic because it wasn't properly managed?
Yeah, part of it comes down to the investment side of it. And I think throughout my 27-year career, I've seen a lot of things go wrong, which puts me in a great position to learn from that experience. Often what happens if we go back to a granular deal, right, where I have tens of thousands of loans versus a single asset. In the single asset, I have a lot of idiosyncratic risk. Often you did a transaction, you think it has a 3-year maturity. but something goes wrong, right? That idiosyncratic one-off situation. And ultimately, that 3-year deal goes through restructuring and becomes a 5-year deal. And between year 3 and 5, something else happens and it becomes a 7-year deal, right? And all of a sudden, your capital is trapped for an extended period of time. Now, if you've done the work and you have really strong collateral, you might get all your money back. But in this business, time is money. And if I'm not earning a return on that capital, that actually becomes a problem. If you have large positions like that in a fund, it can become an anchor, right? It's a drag that always holds you back because you're not earning a return on that capital until you get that capital back and you can redeploy it. So I've seen a lot of things, I think, happen over my career, which has given me insight into managing this fund and not making mistakes that I've seen take place in the past.
So it sounds like you're saying sizing the trades are one of the most important things in terms of avoiding a liquidity crunch or a liquidity issue.
Yeah, allocation, particularly for a single asset, is very, very important, right?
And when you say single asset, you mean a large loan, one large private loan, as opposed to lots of little private loans.
Correct. One large loan, you could do one $100 million transaction. And if something goes wrong with that transaction, it's $100 million in capital that's really locked up. I think when we go back to talking about granularity, whether it's on the consumer side or whether it's on the real estate side where we're doing small balance loans, if I have a small balance loan portfolio and there's $100 million and it's $1 million a deal, I have 100 different positions, right? That gives me diversification. And that's why granularity always gives you some diversification.
When I think about all the options that you have, you're managing across really multiple different types of loans and multiple regions in the strategy that you manage. How do you think about that in terms of relative value or choosing where you want to go? How do you construct a portfolio like this?
It starts with the opportunity set. What is happening in one country or another that allows us to step in and take advantage of this? I'll call it a capital or liquidity vacuum. How can we earn that excess return? Who's going to sit with us and negotiate on a bilateral basis, right? A lot of our structural protections that we get come from the fact that we negotiated on a bilateral basis. We weren't in competition with 10 or 12 other investment managers for these assets. That allows us to get the structural protections. If I think country by country, I'm less concerned about country by country and more concerned about, does the deal have the characteristics that we want?
So you're sourcing deals around the world, but really you're not making macro calls. I mean, you're effectively a bottom-up investor. You're underwriting each deal and assuming that you're sizing them correctly and they have the characteristics that suit your portfolio's needs. Ultimately, they're going to be considered for the portfolio.
Yeah, I would say generally we're not trying to make a big macro call, but we have to be macro aware. And we are not macro traders, and therefore being macro aware may mean that there's some uncertainty on the horizon. And then we ask ourselves, how can we structure around that? Can we give up some of the upside in the trade to get more downside protection because we're concerned about what might be happening with the consumer or some other specific asset class? But really, at the end of the day, it comes back to putting together an all-weather portfolio, right? Something that's going to survive many different economic scenarios that can take place in the market. And if we can do that, we don't have to be experts on the macro. We just need to be macro aware.
Interesting. So are there any sort of macro considerations today that are impacting your thinking around investing across the global asset-backed or asset-based opportunity set?
Yeah, I would say obviously there's a lot of uncertainty on the horizon across the globe. And when we take a step back, I think we're in a position today where we want to see deals that we may give away some of that upside and get more downside protection.
So how does that work? How do you give away some upside to get some more downside protection? Walk me through a deal where or an example of a deal where that would be the case.
Sure. Let me talk about one of the deals in the asset-based finance space, for example. A few of the things they're going to do there, number one, they could do a discounted purchase price, right? If the portfolio is performing to their expectations, we'll make that additional payment at some time later in the future. That might be something where we say we'll give up some of the upside for that. We might hold back some of the servicing fees, right? Servicing is effectively collecting all of those cash flows. And maybe we decide to hold back some of the servicing fee for, again, that additional downside protection. If the portfolio is not performing to our expectations, we're going to claw back a percentage of those fees to kind of make ourselves whole from the return perspective. And there's a whole host of things you can do on the structuring side. But again, it's if there's more uncertainty, you probably want to try to structure in more downside protection, right, to the best of your ability. And if there's less uncertainty, then maybe you're going to try to retain more of that upside.
What kind of companies are you partnering with?
I would say if we're talking about the asset-based finance side, there we have partners that are, we'll call them specialist originators. They have really strong origination capabilities. And we go back to servicing. Everything we care about is collecting cash. If the servicing's not going well, then that means we're not getting our cash. And we're looking for the partners who originate well and service well. And I think you had PJ on and he talked about underwriting the underwriter, and that's something we do. We want to understand how our partner does business. We don't want them to just bring us a whole bunch of assets. To contrast that to the aviation space, our funds actually own an aviation leasing platform, and they see about $1.4 billion a month in deal flow. You have a 70-person plus team based in Ireland, and they're seeing all these different aircraft coming through the market. Some of them are already for sale with leases in place, some of them without leases in place. But again, there are boots on the ground, right? They're scouring the markets globally looking for these opportunities. And the hardest part of private credit in general, I would say, is sourcing assets, right? We know how to structure, do the underwriting and all of those things, but at the end of the day, you need to be out there sourcing assets.
So if we think about your universe, which is rather large in terms of your opportunity set, what are some of the things that are most exciting to you today across the global asset-backed or asset-based finance space?
Yeah, if I think about what we're doing in the fund today in the U.S., we have a lot of consumer-based products, whether they're auto loan portfolios, whether they're point of sale. While if we contrast that in Europe, we're finding some of those deals, but we're also doing transactions where there is effectively a housing deficit, right? Whether it's the UK or Germany, we found specialist originators of assets in countries where banks aren't lending for housing. When I'm talking about housing, these are small balance loans, which means they're 2, 3, 4 unit type properties. We're not talking about putting $100, $200 million into an 800 unit apartment building, right? But again, it's finding those little niche opportunities with someone who has a track record, with someone who we think has great origination techniques and has the ability to service the portfolios.
And you also mentioned the aviation business as being sort of something that is a part of your portfolio. What are your thoughts on that space?
Yeah, I actually think it's really interesting because in that case, we actually have a portable asset, as we say. And what I mean by that is we could have a plane on lease in Italy, and let's say the economy is struggling there, and we can take that plane out of Italy and remarket it and release it into Spain, where the economy is doing well. Now we go back to having that platform, right? If we didn't have Ergo, who's the aviation leasing platform, they're the ones doing the heavy lift when we actually have to do something like that.
And in this case, you're not making a loan. You actually own the airplane in your fund, and you're leasing that out, and ultimately the lease payments are what's producing the income or the total return.
Yeah, that's correct. And a lot of what we do is owning the assets, even on owning portfolios of loans, whether it's residential mortgages or consumer loans. We're often purchasing those assets altogether, including, as you mentioned, the aviation space where we actually purchase the aircraft.
So if I'm an allocator, an advisor listening to this podcast, my first thought is this sounds interesting, but how do I think about this in the context of a broader portfolio? What advice would you give to an allocator who's thinking about putting this into their portfolio?
If you have a lot of corporate credit type exposure, whether it's public market or private market exposure, I think what we're doing on the asset-based side really provides a differentiator, something that's got lower correlation to those corporate type assets and will ultimately allow you to diversify your portfolio. I think experience is important. You don't want to be a tourist in any asset class or any market. When you're in a bull market, it's really easy to say you're very good at something. It's when we have these big dislocations that take place, that's where you really see if people understand what they're doing, because everyone's numbers are going to look good, right, when the market is up and to the right. It's an art and a science, and it's something that comes with time and an experience.
Amazing. Well, Roger, thank you so much for sitting down with me today. This has been a great conversation, and we certainly appreciate your time and your insights.
Well, thank you for having me on the show. It was a lot of fun.
Thank you for listening to today's episode. Please rate, review, and subscribe on your favorite podcast platform. I'm Brian Resnick, and you've been listening to Uncommon Capital.